is it more important for the markets that there will be no more rate hikes in 2019, or that we have more clarity that the balance sheet runoff strategy will end by around September?
I actually think the balance sheet issue is more important. I mean, well, the point is we already knew that the Fed was going to only have one more rate hike. So to take it to go from 1 to 0, and I think a lot of people were looking for that rate hike not to come until the fourth quarter anyway. The fact that we got a definitive time when the Fed is going to stop shrinking their balance sheet was a little bit more important. But the thing we do have to remember, though, is that the Fed has done two things. They've stopped raising rates, and now they're going to stop shrinking their balance sheet. But that doesn't mean that they're going to start easing. And there's a difference between being very dovish and easing. So right now, I think the more important thing going forward is, are we going to get some pickup or turnaround in U.S. growth and especially in earnings growth?
Isn't this what the markets wanted? Isn't this what the bulls wanted, Matt? No more rate hikes, a dovish Fed. Why aren't stocks higher on the backs of this? What does that mean about how much was priced in to this particular inaction by the Fed? I mean, since probably the lows that we saw on December 24th.
Yeah, I mean, the one thing is, like, if this news, of course, had come out after the market had already rallied 10%, it'd be one thing. But we're up 20% off the lows. That's a huge rally, and we've gotten that rally in less than 3 months. So it's a very sharp one. And so people, again, we have a couple of things out there. You mentioned at the top of the show, we have the Brexit situation. We still don't know what's going to go on with the China trade situation. Is that going to be pushed out even further? So there's these issues out there. And after such a strong rally, I think, my father grew up in Missouri, the show-me state. I think investors are now trying to think, hey, we need to see real signs that the slowdown in the economy, in the U.S. economy, is going to turn around, and then again, especially that thing with earnings, because it looks like we're going to get negative earnings growth in the first quarter. Is that going to bottom in the first quarter and bounce back in a strong way? So
the dollar is also very much a key point for this particular move. We saw, of course, the near-term trend has been a little bit lower for the dollar. The longer-term trend has been somewhat higher. That weakening dollar that we saw yesterday, could that be a propellant for stocks and multinational companies coming up? And could that weakening dollar, if it were to persist, be a tailwind for emerging markets as well?
I definitely think so. I mean, one of the things is the emerging markets, they've seen a decent rally, not quite as strong as the U.S. market, but they've seen a nice rally since those December lows. The thing is, it hasn't come with a lower dollar. As you mentioned, the dollar over a longer period of time has been rising slightly. But if it breaks down, and it's now down at the bottom end of that range on a technical basis, it looks like it's testing its 200-day moving average, which is a very important support. It's bounced off that several times this year. If it breaks down below that, that's going to give another impetus to these emerging markets and send them, I think, a lot higher. Again, on a technical basis, you look at the EEM, Emerging Markets ETF, it made a nice double bottom. It's broken above its trend line that goes back more than a year. And if it can make another higher high along with the help from the dollar, that's going to attract a lot of momentum to that group. And so that's when I think people are focusing on a huge rally in the S&P. Well, the EEMs, they've been down for quite some time, the emerging markets, so they could have a little bit more upside than I think people realize.